possible. I hope you are all doing well.
We are fine, sir.
So, today we will be looking at our next chapter. Last week we were able to look at something. We discussed some one or two things, and today we'll be looking at national income accounting. Okay. We'll be looking at how to account for national income, and we'll also be looking at how we compute our various national income variables. There are the various national income terminologies, the GDP, the real GDP, the real GDP, the nominal GDP, the GDP deflator. We'll also be looking at the net national product, net national income, and other as we progress. So if there's any question, please just you can, like I told you the other time, you can just unmute yourself and speak, or put up your hand and I'll call you. We do that. So what we are trying to say is that just as a firm, we know firm owners, just as firm owners keep accounts of their economic activities in financial year. So every financial year, people who have economic activities do, like entrepreneurs, talk about poultry farmers and any other individual. We even plan our lives, plan our financial schedules. So just like that, economy also does it. And we try to plan our financial activities by recording it. Every economy does it. So we do so usually annually. Every year we try to keep records of all the financial activities that, or the economic activities that happen within that particular year. So just like any firm or any business or any owner of a firm does, nations also do calculate the total production of goods and services that happens or occur within the nation. We also do so. So we are saying that nations account for their national income, and it is usually done annually. So we do the national income accounting every year. So why national income accounting is important for a nation? Why is national income accounting? Why is it so important for a nation? So what we are saying is that by accounting it helps us to organize the economic data and the economic activities that happens within the economy. So if we're able to account for it, it gives us an economic data. So when you have the economic data, you can determine whether your economy is better, or whether the economy is booming, or the economy is retrogressing, or the economy is in recession. And that is why we keep records of all the economic activities that goes on within a particular country. And two, it also helps us to classify economic activities into various segments and or sectors. So when you're able to get to the national income, you can able to find out or know which sector. Is it the primary sector or is it the secondary sector that is performing? So if you're an economy and you see that your primary sector actually performs better than the manufacturing sector, then it gives you a clue as to how you can improve the primary sector, or how you can make it work better, or better off if it's the primary sector or the agri sector that is driving development or growth in the economy. Then you know that you are born to catastrophe in case there is an external shock or a drop in the market. So what I'm trying to say is that it helps you to plan when you are able to disaggregate your data into various segments. Now, what we are trying to say is that when we take an economy, economics is made up of the primary sector, the secondary sector, and the tertiary sector. Or you can better say the manufacturing, the agri sector, and also the service sector. So when you get the data, you can put the data into various segments. When you calculate your national income, you can put it into various segments. And by putting it into various segments, it helps you to know which segment of the economy is actually thriving and which sector of the economy is lacking, and that needs help. That is all that I'm trying to say. So secondly, it also helps you to track the total production within the macroeconomy. So you know the production that is going on in the economy when you have the data. And it also helps you to determine the performance of the economy. So if you have data on the financial activities or the economic activities that is going on in your country, it helps you to, it serves as a guide to economic progress. So if you're assuming your GDP is increasing, is going up, then it is telling you that your economy is gradually picking up or is also going up. It means that production in the economy or the economic output is also becoming better off. Then after all these things, what do we do? Every data is for policy formulation and policy implementation. So when you get the data, you are able to calculate and realize that the economy is retrogressing. Let's say the economy initially was picking up. So we saw economy that was initially picking up as a result of increase in GDP or increase in your GDP growth rate. So with time, let's say this is our graph. This is our GDP, which is the y-axis, and our x-axis is the time period, which is year. Now with time, we realize that our GDP was growing. It got to a time it reduced a bit. It started going up, reduced a bit, and it started going up like that. Now, what is this thing telling us? This is just giving us the trend of the country's GDP, and we can only know the trend of our performance based on the data that is available to us. I think somebody has his mic on, and the person mutes himself, and the person turned off his microphone. Hello. Let's go. Ali Moro. You want to say something? Okay, I think someone has his microphone on. If the person can turn it off, that would be good for us. Okay. So what I'm trying to say is that if we are able to capture the production activities within the economy and record them, we can draw a trend. And I told you that we calculate GDP on annual basis, on a yearly basis. So if 2015, our GDP is 3, and 2014, our GDP is 3, let's say it's $3,000. And our 2016, our GDP moves to, let's say, $4,000. It gives us a clue about how the economy is expanding, how economic activities or production in the economy is going up and it's expanding. It also tells us the performance of the economy to see if the economy is progressing or the economy is retrogressing. And it also gives us a clue, assuming the economy is retrogressing. If the economy is retrogressing or if the economy is in recession, when I say the economy is retrogressing or the economy is recession, all that I'm trying to say is that the economic indicators are not in favorable with the economy. So if you look at what I've done, the trend that I've drawn, you see that there are instances where the economy is picking up and there are instances where the economy is falling. So the point where it is falling, we say the economy is in recession or the economy is regressing. And you can't hear anything. You can't see my screen.
Please, we can see it.
That is not possible. Scroll, then look for my screen because we are about 30 participants. When you see my screen, pin it, scroll, and pin my screen on your phone so that it won't change. So if you cannot see my screen, it's from your end. Okay, scroll, look for where my screen is, and pin it, pin the screen. All right. So the point where we realize that the economy's GDP is falling, we say the economy is in recession, or we are experiencing a decline in the GDP. Now, so when the economy is picking up, so we realize that from this period to this period, we see the economy is picking up. So at that level, we say the economy is booming. Okay, the economy is booming, or the economy is doing better. And whenever the economy is in recession, it gives us a clue that what can we do so that the economy can pick up. And whenever the economy is also is booming, then we look at what did we do that is making the economy boom. And if an economy is booming, we don't want the economy to retrogress. Because we don't want the economy to retrogress, we start thinking about policies that can sustain the growth or policies that can help us grow better than we're growing. So we are saying that the most important reason for we keeping data, one, is to help us come out with policies, good policies, formulate policies, and not to formulate only the policies, but to implement such policies and also monitor the implementation of the policy. So when you implement a policy, you enforce it. You are enforcing the decision. So if the government thinks that what Ghanaians need in order to boost productivity by boosting somebody, please off your mic. So if what the government thinks is that Ghana's production is basically driven with the labor. So our production is more labor intensive. We need more labor in order to drive production. And he realizes that if he's to invest into labor by giving free education, then we can produce more. We can have quality labor. We can have quality human productivity. Then the government will continue to channel money or channel resources. Please, I'm saying that if you can't see the screen, it's from your end. So scroll. And when you see my screen, pin it because we have about 30 participants here. And there's a possibility that you'll be viewing another person's picture or profile. So look through my screen, look through the profiles. And when you see my pin it. You are three. And three people using one electrical appliance, a machine. Three people using one phone. Is that me? I don't understand. Are you seeing three participants? No. So if you want to know the participants, we are about 33. We are more than that. And I'm seeing all of them. It's because you are using phone. So your phone screen will only give you the available people. When you scroll, you will see those three people. The others. So don't worry. If you have seen my screen, that is okay. Don't worry about the number of people that are online. Okay. And I'm saying that scroll up. my picture will come and the screen will also come. Please, the rest, are you finding the same challenge?
No, sir.
No, sir. I can see.
So it's not from
No.
yes. So it's not from my end. It's from your end. Look, that's what I'm saying. That tap on the phone and scroll.
The person should scroll down.
Okay, then scroll down. Okay, let me continue. So all that I'm trying to say is that with the data, the data will give you an information or a clue about the situation of the economy. And when you look at the situation in the economy and you think that you want to sustain the situation, the most important thing is to continue implementing the policies that were giving you the bumper harvest, or that were giving you the favorable results. So if you are getting, the economy is not booming, then you think about other ways or other policies that can help the economy to thrive back. That is what we are trying to say. So data one will give you data. It will give you a clue about how the economy is performing. It also helps you to track the total production within the economy. And it also helps you to compare the trend of growth within the economy. And two, it also helps you in policy formulation and policy implementation. So that is the main reason why we keep records of our national income. And it's very important. Okay. So what is national income in the first place? National income would also mean the same as national product. It also mean the same as our national expenditure. It will be the same thing. The measurements are equivalent. They are identical. They are the same, almost the same. It doesn't mean they are the same values, but it's almost the same. So let's use the word almost the same. So when we talk about our expenditure, our national income, we are saying that it provides us a measure of the total value of final goods and services which are available either for consumption or for addition to wealth. So our national income or our national product or our national expenditure will provide a measure of total value at factor cost. So let's take note of this one to explain what the terminology is at factor cost. So national income is also the total income that accrues to the resident or the inhabitant or the normal residents of a country for participating in economic activity. So here, the word here is what? Economic activities. The income that goes to the residents of a country. And these residents of a country get the income by participating in economic activities within a certain year. So the focus here is you getting an income. We are trying to calculate to know the total income that went to the inhabitants or the indigenes or the normal people living in a certain country for participating in an economic activity. So we are saying that the definition of national income, it includes all the income that is received by the individuals in the form of what? Wages, rent, salaries, interest, profits. Okay. Whether these things were retained in the private business or a government body as a result of their economic activity. So what we are trying to say is that any income, and the income, we all know that when we talk about income, the income that goes to the factors of production. So we are looking at the income that will go to the labor, the income that will go to the capital, the income that will go to the entrepreneur, and the income that goes to maybe land. So when you look at the factors of production, we have labor, we have land, we have capital, we have the entrepreneur. Okay. And the reward that goes to all these four people or these four major people determines the income of the country. And we are saying that that economic agent, we are looking at these economic factors of production: capital, the labor, the entrepreneur receives a certain income. But for the income that goes to them, they must participate in what? Economic activity. So any income that comes to us where there was no participation of economic activities, we do not consider in accounting for our national income. Please, is it okay? So I mentioned some income that we can include. So the income that we include is the rent. And we all know that rent goes to land, which we all know. And as labor, we also receive wages and we also get salaries, which we all know. And as capital, we make profit or we make interest on our investment, which we know. And after the entrepreneur has paid all his workers, the entrepreneur also gets something. And the reward for the entrepreneur is the profit that he makes after he has paid everybody, has paid the capital, he has paid the labor, and sold all his things. The reward that he gets is the profit. So that we should keep in mind. So these are the indicators that we add to get the total income of a country. And we are also saying that this income should come from the person engaging in economic activity. So this tells us that there are some income that people get without necessarily engaging in economic activity. Sometimes we, the guys, it's very difficult for us to get such income. One has to be with gifts. It's very difficult for us to get gifts at times. Today is Father's Day, but nobody will give you anything. So that is what it implies. So when we are given a gift, we do not include gift because you did not take part in any productive economic activity. Okay. We also consider issues like consumer's debt, borrowing, we borrowed something, and the grants that we also received without engaging in any productive activities are also excluded. Please, do you get it? Why do we exclude them? Because we exclude them because there's no productive activity. We exclude them because the gift that someone has even given you was also let's look at another one like remittances. You are there, your brother is in abroad, you are there and he sends you some money. You didn't do anything, he only sent you the money. So those ones are remittances. We do exclude them. So remittances, the money that we receive from our relatives and our friends, our parties in the form of gifts are also excluded. So national income is calculated as a factor cost. Okay. So when we are calculating national income, we calculate national income at factor cost. So I will explain what that means to you later. So let's keep it down and say that our national income is always at factor cost. So we'll come back to it. Now, let's go on. So the next argument we are saying is that our national income is also defined as the total earning of factors of production, which I mentioned already to you. So we have our earnings, total earnings of factors of production that are used in producing final goods and services in an economy within a given period of time. So I highlighted the final goods and services. What are the final goods and services? We'll also explain what final goods and services is and look at intermediate goods as well. So let's look at some of the working definition of our national income. So national income, when we talk about national income, like I told you, we are looking at the sum of the rewards that was accrued to the factors of production. So the rewards like land, so we look at rent for land, wages and salary for labor, We are looking at interest on capital, the profits for the entrepreneurs, which this one I've mentioned already, which are received for producing final goods and services for a specific period of time, normally within a year. So if the rent that the person received was last year, we do not include it now because it has been over captured already. And the main focus of the national income now is to account for today's production or today's economic activity that transpired. So previous economic activities are excluded. So if you built last year and we are accounting for the national income today, your building last year will not be considered, will be excluded. So national income accounting is to determine the total monetary value of total production of goods and services by the normal residents for a given period of time. What are we saying? What we are saying is that the main reason for accounting for national income, one is to determine the monetary value. So that's why at times we say that our national income is 6,000 US dollars. Ghana's national income is 6,000 US dollars. What we are trying to do is just to quantify the production activities or the total production of goods and services that were done by the residents of a country in a given year. So by the residents of a country, we don't care about your nationality. Our main focus, either you are a foreigner and you are a resident in the country, or whether you are a national and you are a resident of the country. That is what we are interested in. So we are looking at the residents of the country that are into production within a given year. So every year we looked at the total monetary value of total productions that have been done by the normal residents of a country in a given year. That is what the main concept of the national income is concerned. And there are some terminologies or definitions that we are going to come into look at particularly. So when I told you that national income, we mentioned some various terminologies as and when we started explaining our national income. We mentioned final goods, we mentioned that the monetary value and other things. So let's look at what do we use to measure our national income. Now, one of the things we use to measure national income you have people there. We have people to oh, for that area, they will not be able to. For that area, they will not be, but I'm not on that page. Okay, let me not get please. We still have people there. Hello.
Yes, sir.
I'm being told that yesterday's link, some people are still working. So give me some few minutes. Let me go there and address them so that they can join this.
Okay, sir.
Okay, sir.
Oh, okay. So when I speak, you people hear me. Exactly. Okay. Okay. So I thought I've closed this page, to be sincere. I thought I've closed this page. I never thought that you people are still there. I thought I've closed the page. So please, let's move from here and join the other link. Okay, this is the fourth time I'm sharing the link, but I'll give it to you right now. Oh, me, I thought I closed the link. That's why I'm not. Oh, serious. I'm sorry. I thought I opened it just to communicate to the people here, and I thought I've closed it. I didn't know that you people can hear me. So it's even recorded. So yeah, so I think the communication should come clear from the code representative. Which one are we using? Are we using this one or the one that they gave us last week? So why did they give us the other one? Because I was also having this one. So code rep, please, are you there? Can you hear us? Can we resolve this issue once and for all? Hello, sir. Hello. Hello. Oh, she's not there. She's not listening to us. Okay, please, I've shared the link. Have you seen it? Francis Baffo. Gladys. Hello.
Please, not yet. We haven't seen it.
Oh, I've just shared. Check.
So please,
You've
is
seen
it
it.
on the WhatsApp page or here?
No, here.
There's no message here.
No, sir. There's no message here.
I've shared.
He's not referring to it. He's referring to the old link.
Okay, the other.
Or
Okay. Yeah, I think so.
the other link.
You people spoke to okay, let me.
But the way the link was shared, some of us, we can share it to our colleagues to join.
You can share it.
When you shared it on the old distance, when I try copying it to paste on our page for them to join, it's not copying. And I can also share it from there.
No, but I think I've copied it and sent it to the platform. You can even copy it here.
Brother Ken. Brother Kennedy. Brother Kennedy. I can't hear you.
Yes, sir. Yes, sir. Okay, sir.
Please, have you all come? Are you all here?
Yes, sir.
Yes, please.
Okay, I'm waiting for Mubarak. I've not seen Mubarak yet. Mubarak, I'm waiting for you so that we can just close this one and and focus on the other page. Mubrak, have you seen the link? Hello, Mubrak.
Say Mubarak what?
Mubrak Zakaria. He's the only person here. So, okay. So when I've shared the link twice, so I'm sure that'll be okay. So let's go on. So from time to time, I'll be monitoring that place to see if okay. So can you? I hope you can see my screen. You can see me now.
Yes, sir, you can see it.
Okay. So let's continue.
Yes, we can see it.
All right. So let's continue. And sorry for the inconvenience. I think
Yeah, sir, please. You were saying that some people were on the other link.
yes, I have
Last
tried to.
semester's link.
Yeah, not last semester's link. They said that link is on the page on the timetable. That's the link on the timetable.
Yeah.
So I think that is where I even started, and I was called to use this very link. So I think we should save this link and use this link rather.
Okay.
And I didn't know that I didn't mute, and I've opened to that. I've opened to that page also. And so whatever I was saying here, they could hear, just that they couldn't see the slides because I wasn't communicating.
Okay.
Now I understood. So they could hear everything that we are doing, just that.
Okay.
So let's continue. And thank you for the time also.
So, sir, please excuse me. Which link are we using for now for the subsequent lecture?
Let's stay with this one. Because I know this is also being recorded. The other one too is being recorded. So it tells you that the monitors are aware of the two links.
Okay.
So let's go on. So from the definition that we have been looking so far, we've been able to find out why we need to keep records of our national income. And there are some terminologies that we want to understand. So we talk about gross domestic product, which I've been mentioning. So this one, even if I asked you to define it, I know most of you can explain it, what the gross domestic product is. And I also told you that what we are interested mute yourself. I prefer that when we are having a class like this, students will be seated so that they can have something to write, jot something down. But if you think you listen to it as a radio, get seated. Don't be moving around.
Okay, sir.
It's time for class. You get seated. Your phone is in front of you, and you pick a book or a paper. There are certain things I may say. You put it down. Okay. All right. So let's go on. So all that I'm trying to say is that when you talk about national income, our national income, we said that we intend to reduce the total monetary value of goods and services or productive activities that happened within an economy in a given year. And if you do remember, I also told you that the focus was also on the nationals or the residents, the inhabitants of the country. And I told you that we are not interested if the person is a foreigner or if the person is a local, a national. Our main concept is the fact that the person is living or is a resident in the country. So we are looking at that makes it domestic. That is why we say it's domestic, gross domestic product. But the production that is being or going on domestically, that is what we term as the gross domestic product. We may also be interested in what the nationals are also producing. The one that nationals are producing, then we have to take away the foreigners and focus only on the nationals. I hope that is also clear. So when we talk about the gross domestic product, the emphasis is on the domestic. So what we are trying to say is that when we talk about the gross domestic product, we are interested in computing the total monetary value of all final goods and services produced in an economy in a given period. And the period is always 1 year. So GDP, which is the gross domestic product, totals the monetary market value of final goods and services that are produced. So we are looking at the monetary market value of final goods and services that are produced. And before we can know the market value, the value of total goods and services, these goods must be brought to the market for it to have price. So if you don't have the price, you don't know the price of it, it is very difficult to determine the value of the goods and services that you are being produced. So what determines the value of a good is the price of the good. Please, I hope that point is clear. So we are saying that final goods. What are final goods? Another term that we are making is the final goods. So when we talk about final goods, we are only looking at goods that when we buy, we are just using it or we are consuming it. So these are goods and services or goods which are purchased purposely for final use and not for resale or for further processing or further manufacturing. Example, I buy bread. When I buy bread and I'm going to consume the bread, it is a final good. Okay. So the basic question that we ask is that why do we emphasize or insist on the production of final goods and services? Why? Now we find out that if we don't focus on final goods and services, we may calculate transactions double. Let me give you an example. We all know that we get flour from wheat. I even got to know this when the Ukraine war happened, and people said that now they are not getting wheat, and so the price of bread has become very expensive. And I say, how does bread got to do with wheat? Then I was told that we use wheat to produce flour, and we use flour to produce bread. Initially, I didn't even know that we use flour to produce bread. Okay, so let's assume that we know that we can produce wheat. We can use wheat to produce flour, and we can use flour to produce bread. Okay, so when I buy wheat, and I'm not going to consume it, and I buy wheat with the intention of not consuming it, but I'm buying the wheat so that I can produce flour. I hope you get it. So I buy the flour. So I buy the flour, not to consume the flour, but I can add. I can, so you are the only one at the old Lincoln. Mubarak is still there. Leave Mubarak. Leave Mubarak. You can leave Mubarak there. Mubarak. Leave Mubarak. I been speaking to Mubarak. He's not minding me. So let me share. No, he can hear me. He has just joined and he's somewhere. I'll share it with you. Yes, I'll share it with you. So Rose is also here. I don't know what they are doing there.
So the issue is that when we mistakenly go off, we join that one.
Oh, sorry.
That's why.
So Rose, Rose, you are the one that I'm talking to. So we have Rose, myself, Brad. We are all on this page again. Okay. So Rose, kindly join. You are welcome. Okay.
So, sir, I suggest you paste the link for this page on the WhatsApp platform.
Oh, okay. I'm not using my phone. No, that is the main reason. My WhatsApp is on the phone. So this one, I picked it from the page. I don't know if somebody is using his phone and he can copy this page and put it on the WhatsApp platform. That one will be better. Please, you get it?
Sir, please, do you mean we should copy the link for this meeting onto the economic
Sir, please, the
It's
link is already there. The link is
already-
already there.
It's already there. So please, those people who
It
are
has been
here,
shared. It has been shared on the platform now.
okay. So those people who are here and are not part of our WhatsApp group, please do well to join the WhatsApp group so that you have access to every information that will be shared. Okay, so let's continue. So the argument that we are trying to say is that now we know that flour, we use flour to produce bread. So if we assuming the price, let's assume the price of wheat on the market. So this is our wheat. This is our wheat. Let's say the price of wheat is 70 Ghana cedis. Okay. And the price of flour on the market. You and I know that when what we call, if I produce flour, okay, if I produce flour, I will sell it above the price of wheat. Is that not it? Because I bought the wheat to sell the price. So flour will surely be above the price of wheat. Is that not it? So let's assume the price of flour on the market per bag is 90 Ghana cedis. And then we also assume that our bread, making B, is equal to 100 Ghana cedis now. All right. So this is the value that we have attached to it. Now, if I want to calculate for the what we call the domestic production that has gone on in the economy, somebody will just add 70 plus 90 plus 100, and that one will give us about 260.
260.
Okay. 260. So the thing is that when you add all these value and get 260, what they are trying to say is that, look, you are wrong. You are wrong because you have added some of the values twice, because you have captured wheat already and you went to capture flour, but the value of the wheat is embedded in the value of the flour, and the value of the flour is also embedded in the value of the bread. So when you add them together like this, we say you have double counted the value of the bread or the value of the production that went on. So what we do now is to focus only on the final goods that have been bought. So if you want to look at the production that went on in the economy, then we will focus on only the bread that was produced. Okay. So the value of the economy in terms of production, the monetary good, will be the price of the bread, which is the final product that was produced, and that will be 100 Ghana cedis. So to avoid double counting, we work with final goods, or you look for the value addition. So they are telling us that too. It's either you are working with the final goods or look for the value addition. When you talk about value addition, what is value addition? Value addition is the extra value that you have added to the product. So when you took the wheat was not flour, but you added value to the wheat in order to get the flour. Please, do you understand? And when you had the flour, you don't eat the flour. You have to add a value to the flour to get the bread. Okay, so we have two ways of looking at it. One is to get the value addition, or two is to focus only on the final goods and services. So here what we are saying is that when I bought the wheat, what is the value of the wheat? The value added to the wheat. Wheat was there. It was just there. So the value of the wheat is the same 70 Ghana cedis. So we put our value of the wheat to 70 Ghana cedis. Then we process the wheat to flour. and sold it at 90 cedis, what is the value added to the wheat? So the value added to the wheat is the 20 Ghana extra that has been added to the price of wheat. So we find the difference between the flour and the wheat, and that one will also give us 20 cedis. Okay, then we also look at the value between the flour and the bread. So by processing the flour into bread, we had a value, the extra value that was added was 10. So when you add all this, you should get the price of the final good. So when I add this, I add that, I add this, I'm going to get 0. I add this, I add that, I get that. I'm going to get 10. So it is either you are using a, it's a, who and who, are you sure you are not at the old place? What's your name? And David, you are new in Jerusalem. You joined late. Hello now, David. Alicia, you people are not supposed to be on this. Please use the link to join. And they say they have shared the page on the WhatsApp, on our WhatsApp group. So please use it.
Yes, now that I've given them the right link, so they are using it to join.
Okay. So David, please do so.
And they should go to our platform.
Okay. David, do so, and then enjoy. So I've even shared it with them. So please, I hope you can continue.
Sir. Yes, sir.
So basically, what I was drawing is so basically, we have we been able to get what I was trying to say? That I'm saying that it's either if you want to avoid the double counting, then you should focus on what the final goods and services. And I've been able to demonstrate to you why the final goods and services is important. Or 2, you look at the value addition. And if you don't do that, you are going to double count. Okay, double count means you are going to repeat yourself. You're going to repeat the value of the product as well. So that's the main reason. And to avoid double counting, what we tell is we look at the value addition, or 2, to focus on final goods and services that are being produced in the country in a particular period of time. I hope that is clear. All right. Then we spoke about value added. What is value addition? I hope by now you all understand. So I will skip this one because I've explained it. This is what I wanted to use. This is what I used to demonstrate. This is our flour. The flour example that I used to demonstrate it. Okay. And the miller turning the flour into bread. So all that we are saying that with value addition, what we mean is that you are adding an extra value or an extra wealth to a product in the course of production. So when the firm or a producer is adding another extra wealth to a product in the cost of production, that is all that we term as value addition. And what we want is that we want to increase the value, the actual value of whatever we have produced. So if you remember Ghana, we say we export gold in raw terms when we should add value to gold. So we have been hearing this every day. What do we mean by adding value to gold? What we mean is that we should add extra wealth to the gold that we have. Or if it's about adding extra value to cocoa, which means we should add extra wealth to the cocoa that we have. That is simple as that. So with value addition, to know the value, I gave an example here. So the example that I gave here is that we should assume there is a Gary processing firm that purchases cassava. So it purchases cassava for 100 Ghana cedis and later turns the cassava into Gary, which sells or values at 50 Ghana cedis. So if I want to look at the value added, it is just the price of the cassava minus the price of the Gary that has been processed. That is all. That's the value added. And the value addition now becomes 50. So the value addition with the farmer who has been producing the wheat, and the miller who has been converting the wheat into flour, and the baker who has been using the flour to produce bread. That one too, by the grace we have. Just that I use different values. We have been able to explain it, get a better understanding. So if you look at the cassava, if you look at the flour, and then we look at the wheat, how do we term? What term can we give to those goods and services? And we are saying that those ones, we consider them as intermediary goods. So, or intermediate goods. You want to ask a question? Okay, Joshua, please go on.
Yes, please. Please, I didn't hear it well. The second one, the example.
Which example? The flour.
Yes, please.
So the flour. What I was trying.
No, this one. The Gary.
The Gary.
The assumptions. Yes, please.
Yeah, the Gary. I was trying to say that assuming a farmer cultivates a cassava. Okay. The cassava, the wealth of and then somebody goes to the farmer and buys the cassava for 100 Ghana. Or let's assume that the farmer buys cassava, source cassava at 100 Ghana cedis. A firm went to the farmer and bought that cassava. So the wealth of the cassava now is 100 Ghana cedis. So we say C is equal to 100 Ghana cedis. And then the firm turned the cassava into Gary. So when he turned the cassava into Gary, now he used the Gary, and the wealth of the Gary, which is G, is equal to, let's say, 150 Ghana cedis. And if I want to find the value added to the Gary, okay, the value added to the cassava, then it is going to be the value of the cassava minus the value of the Gary now. And the value of the cassava, we had 100. And the value of Gary, we had 150. So if I want to know the value that has been added, it is the difference between the cassava, the Gary, and the cassava, the prices. And I told you that to know the value of a commodity, we use the price to determine the value of a commodity. So it's the 50 Ghana that we are talking about in the trade. So I'm also trying to let us understand that with the example of the flour that I brought in, the flour is also a product. Okay. And that flour is what we have added value to for it to become bread. So we are saying that the flour is not a finished good, but it is an intermediate good. Or some people will say it was used as a raw material. Okay. So all raw materials, because we have not added value to them and they are not consumed directly, becomes an intermediate good. And we all know that your final good can even be a raw material to another firm. Okay. So what we try to look at is to get a final commodity, or look at the value added to that commodity and use it to compute. So what are intermediate goods? When we talk about intermediate goods, we are referring to goods and services that we buy, not for direct consumption, but when we buy them for further processing, or for further manufacturing, or for further resale. So when we buy intermediate goods, so when you go and buy the flour, you are not going to consume the flour. You are going to turn the flour into bread and consume the bread. So whatever that you are buying, any good that you are buying for further processing, for further manufacturing, is what we term as an intermediary. Okay. So they are goods used to produce other goods rather than being sold directly to the consumer. Let's take an example of other goods like cement. We buy cement not to consume cement, but we buy cement just to use it for construction. Okay. So when we are valuing it, it is the house that has been built that we are going to consider, which is the final good. We are not going to consider the cement. Yes, Thomas, please.
So please, I have a question. So with the intermediary goods, is it the same as capital resources?
Every capital, listen to me, Thomas. Every capital can be an intermediary good. When we talk about capitals resources are the ones that aid us, the machineries that are aiding us in the production of goods and services. So the capital can be an intermediary good if it is being used for production, further processing. But if the capital, yes, if it's being used for further processing, then we consider it as an intermediary.
All right, sir. Thank you.
Okay. So we have goods that can be used as an intermediary good. So let's look at a capital like car. Let's look at a capital like car. When you buy car, do you use the car for further processing or you consume the car?
You consuming the car.
You can consume the car. So the car becomes what? A final good. You are not it.
Yes, please.
Okay. So now, what did we use to produce the car? What we use to produce the car becomes the intermediary. I hope you get it.
Yes, please.
So most of the machineries that are used in production, if they are directly consumed, they are used directly, then it becomes final good. But if it's being used for further production, then it becomes intermediary good. So even our clothes that we wear, the steel, the cotton, we get it from cotton. So when we get the cotton now becomes an intermediary. The cloth now becomes final good. So it depends on how you are arguing it from. And that is what makes national income accounting difficult, because you have to be able to differentiate between what an intermediary good is and what the final good is, which is very cumbersome. Okay. Now, we also said that, if you do remember, I told you that we account for a particular year. We account for a particular year. So any output that is being done in the previous year is excluded. We don't consider any output that is being done in the previous year. So the focus is on current output. So when we talk about current output, we are only looking at production that was done in the current year. So currently produced goods and services are what we include in the GDP, because we believe that the previous year's output has already been impacted. So a house that was built, a real estate that was built in 2025 will not be considered when we are accounting for the income, the total product of the country. So our interest is to account for the output within a defined time or an accounting period, say 1 year. That has been our interest. So therefore, in accounting for GDP, we exclude transactions involving commodities, such as existing houses or stock that were done. Existing houses that are still existing, we don't consider it. Construction of new houses that were constructed within the year is what we try to. Is someone still at the old page? I'm sure I'm hearing a voice. I'm sure that somebody still at the old page. Now, let me brush you quickly through what we term as the market price and factor cost. If you remember, when we were defining the national income, I told you that national income is measured at factor cost. Please, I hope you do remember that one. Okay. And I told you that in an open market, let's assume that there's an open market. Now, when you talk about open market where goods and services flow. Now, there's always government there who imposes taxes on goods and services. Now, our knowledge from our microeconomics tells us that the government takes part in the economy from two areas. One, either the government is coming in with a fiscal policy. Government controls the market from two angles, from fiscal policy and also from monetary policy. From the monetary policy perspective, it is usually done by the central bank, which we will discuss it. But somebody has opened another lecture. Please. Okay. So what we are trying to look at is that we look at one, the government comes into the activity from fiscal policies. And we look at fiscal policy from one, government expenditure, where government is trying to spend, to talk about it. And then two, where government imposes taxes. So we have instances where government imposes indirect taxes. These are taxes that are imposed not directly on our income. Okay. So whatever we buy from the market, every consumption we buy from the market attracts some kind of taxes that are being imposed on it. We all know that we have taxes on fuel. So every liter of fuel that we buy now, we pay a 1 Ghana cedi tax on the commodity. So the question now is that the government also gives subsidy to some firms in order to be more competitive. Now, the subsidy simply is income that any money that is coming from the government to the household, or either to the individual or to the firm, in order to make them more productive. Okay. And from our knowledge in microeconomics, we were told that whenever government imposes taxes, it affects the price of the commodity. So if you do remember, when government imposes taxes on fuel, 1 Ghana cedi on fuel, prices of fuel increase by 1 Ghana cedi. So when we go to the market to go and buy fuel, we are going to buy fuel at a higher price. Is it okay? And that is the market price. But in reality, the price of the product should have been, let's say, 5 cedi, 15 cedi. Now we are buying fuel at 15 cedi. Let's say 15 cedi per liter. So the argument that we are trying to say is that if we go to the market plus the tax, we are going to buy the fuel at 16 Ghana cedis. Okay. So that is the market price that we are buying the fuel. So assuming that we want to know the actual price, which is the actual factor, the cost of the fuel, the actual cost of the fuel is not the 15 cedis. It is what? It is not the 16 cedis, which is the actual cost, should be the 15 Ghana cedis. And how did I get these 15 Ghana cedis? I have to take the tax that the government paid, or we pay to the government imposed from the market price. So I always have to take my indirect taxes from the market price. Is that okay? I hope that one is understood. All right. So if that is understood, so what we are trying to say is that anytime I want to find the market price, the actual factor cost, then I have to take away what? The taxes from the market price. Then I'll get the actual cost of the product. Secondly, we are saying that government gives subsidies. Government may also give some transfers. So if government is giving subsidy, assuming that the government has given subsidy is going to reduce the amount of production, the actual cost of the product. Government gives subsidies to firms so that they become competitive, so that they can sell less on the market. Less price, not in less quantity. I'm talking about lesser price on the market. So if I want to know the actual cost of whatever was the government was, whatever was sold on the market, hey, Ima, you have pinned yourself, or you have pinned me. All right, now my slide is somewhere. Oh, all right, let's go on. So now, if I want to know the actual, please, I hope you can see my screen.
No, sir.
No.
No, sir. We cannot. We
No,
can't
sir.
see.
I can see.
See, but not the same.
At first, it's showing, but now it's not showing again.
Yeah, somebody has pinned it.
Yima is not presenting.
Ima,
No, when you scroll down, you will see masters. Let's
no,
just.
Ima is not presenting. Ima has pinned its page. Now it's okay. Now I think everybody can see me now.
Yes, sir.
Yes.
Yes, please.
Okay. Ima, please don't.
We can now see you.
Don't tamper.
He has left.
Okay. The one with the motorbike, please, off your engine. So the argument you are saying that, or you can use your engine useless. Please, let's mute ourselves. Let's mute. Let me check. I'm coming in. Let me also. Okay. So, can the person mute himself? Sarah, you people are still here again. Hello, Mariam.
Hello.
Hello,
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 can
sir.
hear you.
Hello, sir. We can hear
Hello,
you.
sir.
Yeah, but you people are in the wrong page there, with the wrong page. Sarah, Peku, and then Enu, and Mariam, Seidu. Can you hear me? Sarah, I've shared the page. Please use the page to join. I've shared the link to join. You and this same. Have you seen it? I've shared it on your, because I want to log out from there. I want to log out from there. Enu, are you there? Enu,
Sir, please tell Mariam to go to our WhatsApp page. There, the link is there.
Mariam, go to the WhatsApp page. The link is there and join.
Tamale, WhatsApp page.
Oh,
Go to
hello, sir.
Tamale. Yes, please.
It is raining here, so I have to put the phone where the speaker is to my ear. So I don't know that I have tapped on something. Yeah, affected you. So I'm sorry.
No, don't worry. No, don't worry. Don't worry. Enu, yes, please. Use the link I've shared. Use this link I've shared. Use that link to join. Okay. Nobody should come to use this page again. Sarah, please use the link. I want to exit from here because it is giving me some kind of feedback. I want everybody to move from this page. Sarah, have you seen it? Sarah, have you seen it? Okay, please join.
I've not seen the link that you shared.
Yeah, close. No, not with our page. Not with our page. I was talking to those guys from those who were behind, who were using the other link. I've closed it.
Hello, sir. So are we still having a class here? Or
Yeah, we are having the class here. I've closed their page. I don't and it has been giving me some kind of feedback. All right. So you get the explanation that I was trying to make. I'm trying to say that whenever the government imposes taxes, the price of the commodity that comes to the market is higher. And whenever government imposes a subsidy, the price of the commodity that comes to the market is lower compared to the actual price. So if I want to get the actual price, then all that I have to do after getting the market price is to subtract the tax from the market price. Okay, subtract the price from the market price. So I'm going to have market price minus the tax, and the tax is indirect tax. If government gave a subsidy, then I have to add the subsidy that the government gave. Okay, and that will give me the factor cost. So if I want to get the factor cost, then I have to get the market price, take out the tax, add the subsidy. I hope that is okay. Is it okay?
Right. The line was breaking, so I didn't get there.
Okay, Nkrumah, what I'm trying to say is that the government in every economy performs two major activities to regulate price. And the first thing he does is to impose taxes on us. And the second thing is to give us subsidy for us to be more competitive. Now, what I'm trying to say is that every product that comes to the market, when you go to the market to buy something from the government, from something for yourself, it has a tax component. Okay. And these tax components affect the actual price of the commodity on the market. So if I want to know the actual price of the commodity on the market, then I have to take away the tax. Please do get it from the price of the commodity that I bought.
Okay.
So now when you go to the market and you are buying fuel at 16 cedis per liter, actually the price is not 16 cedis. The price may be around 15 cedis because the government now is imposing a tax of 1 Ghana cedi on every liter of fuel. That is what argument I'm trying to make. So if you want to get the actual price, which is the factor price, then you have to subtract the taxes, the indirect tax. And I'm also saying that government also gives subsidies. He also support, not always that he gives to us. He also supports us in terms of some money. Then when the government gives you that subsidy, the subsidy is going to make price of goods and services on the market cheaper. So if I want to know the actual cost of the product that was produced, then I must add subsidy. So what I'm trying to say is that for our GDP, it is always calculated at what? Factor cost. And because it's always calculated at factor cost, I have to, if I have to convert, after getting the market price, after you have gone to the market to take the market price, you have to subtract indirect taxes and add subsidies. So when you do that, that is when you get the actual value of the commodity that was produced. Is it okay?
Yes, please. Okay. Thank you.
That's okay. So I have some graph here to explain it. But now that explanation, so we can go ahead. So we are saying that we now know what a GDP is. Now, how do we know? Because I told you that when you talk about GDP, it's a domestic income, gross domestic income, gross domestic product. It's a domestic thing. But our main interest is not about the domestic. We want to see how the Ghanaians are performing. Okay. But when I told you that when you talk about domestic, we are looking at what everyone is doing in the economy. But no, when we are more interested in what nationals are doing, that's what we term as the gross national income. But the domestic income will give you the productivity that is going on in the economy, in the domestic economy. But this time we are saying that no, why don't we look at only what Ghanaians are doing? Then that one will give us a clue about gross national product. So with the gross national product, we are looking at the total market value of final goods and services produced locally, produced domestically, produced by domestically owned factors of production in a given year. So the emphasis is on what? domestically owned factors of production. So we are going to look at factors of production that are only to the domestic country. So if it's South Africa, South Africans are only looking at what the factors of production that are owned by South Africans within a given year. If it's Ghana, we are Ghanaians, so let's focus on Ghana. Then our factors of production owned only by Ghanaians. So when we talk about domestically owned factors of production, what we intend to look at is that the factors of production owned by the actual nationals, either the person is sited in Ghana or is sited outside Ghana. Is that thing correct? Okay. So how do we know it? Now, for us to know it, now we have been able to get our GDP. Now we know that this GDP has factors of production that are coming from foreigners, because here we have the Anglo-Good Ashanti, let's say the one at Takwa Mines. Let's assume there's Takwa Mines. We have MTN. We have other firms that are owned by foreigners. But we say, no, look, let's take those foreigners, their production out from the country. Then look for Ghanaians who are outside the country and come and add it. That is all that we are trying to look at. But in the domestic, we have foreigners in it. Okay. But let's take those foreigners out. Let's take them out. Then what about the Ghanaians who are outside? Let's bring them in and we add the Ghanaians who are outside. That is all that this is telling us. Okay. And we are saying that the difference between our gross domestic product and the gross national product is the net factor income from abroad. Now, what is the net factor income from abroad? The net factor income from abroad is only telling you the differences between the factor income earned by Ghanaians abroad and the factor income earned by foreigners who are living in Ghana. Is it okay?
So please come again.
I am saying that when we talk about the difference between your GDP and your gross national product, which is your GNP, is the net factor income from abroad.
Okay.
And we ask, what is net factor income from abroad? And I'm saying that the net factor income from abroad is the difference, okay, between the factor income. When I talk about the factor income, we are looking at the income that goes to the factors of production. The factor income that is being accrued to foreigners who are in Ghana, and the factor income that is being accrued to Ghanaians or nationals who are living in foreign countries. Is that okay? So we say that for me to get the net factor income, I have to get the foreigners first. Income that is going to foreigners minus the income that Ghanaians are making outside Ghana. Is that okay?
Yes, please.
So I'm saying that the differences between the GDP and the GDP arise because some of the output produced within the country is made by factors of production owned by foreigners. But these foreigners are staying in Ghana. Okay, so these foreigners who are staying in Ghana, we have to take them out and bring the Ghanaians who are rather living outside, living abroad, we bring them in. So the difference between the two is what we term as the net factor income. And the net factor income can be positive or it can also be negative. If it's positive, then it means that Ghanaians are making more income outside compared to foreigners. And if it's positive, negative, it means that foreigners are making more money compared to Ghanaians outside. Foreigners in Ghana are making more money compared to Ghanaians who are living outside. That is simple as that. I hope it's clear.
Yes, please.
So the foreigners in Ghana their factor income, minus Ghanaians abroad, their factor income.
Yes, sir.
Okay. Let's go on. So the capital stock. Now we all know that whenever we are producing, when I'm producing something, I produce. When you are producing anything, you produce with you are producing the capital. You are producing with you are producing the capital. Anything that we produce it with capital. And it is not every year that we buy capital. I bought my car like 3 years or 4 years. I know you also bought yours maybe like 5 years. It's not every year that we buy an asset. Just like firm. Firms also buy their capital stock. And with year, they use the capital stock for production. And whenever they are producing, this capital stock will devalue, it depreciates. How you bought it and how it is now will go down. So what I was trying to say is that it wears out. Okay, capitals wear out. And when capital wear out, the value of the capital continues to decline. So what do? We account for the use of the capital that are being used in production. And how do we account it? We account it by every year trying to find out how that capital is depreciating. The capital has to devalue. We depreciate the capital. So at times you see we call it capital consumption allowance. Okay, the capital, it keeps depreciating. And what you are saying is that when we take the capital depreciation from our GDP, it should give us net instead of gross. You know that GDP is gross domestic product. Okay, gross domestic product. So when we take the gross, the depreciation from the gross, when we take depreciation from the gross, this gross changes. Oh, what is happening? When we take depreciation from our gross, the gross becomes net. DP. Net domestic product, because we have taken depreciation out of it. Now, what am I trying to say? Let me summarize everything here. What I'm trying to say is that after you have calculated your GDP is always at market price. And I'm telling you that our focus to get the national income must always be at factor cost. So after you have calculated your GDP, it is at market price. Now, when it's at market price, all that you need to do is to convert it from market price to factor cost. That's the first stage. Now, how do you convert it from market price to factor cost? I said that after you have taken your GDP, take away taxes, and add your subsidy. When you do that, you are going to get GDP at factor cost. Now, after you have got your GDP at factor cost, what do you do next? You take your GDP at factor cost minus your net factor income from abroad. And I told you that when you add or you subtract your net factor income from abroad, you are going to get your gross national product. And it's also at factor cost. Okay. Then the next step now, after you have gotten your gross national product, is to subtract depreciation or capital consumption allowance. Now, when you subtract depreciation, this gene will go and become net. And that one will give you the net national product at factor cost. This is what we term the national income. The net national income at factor cost is what we term as what? The national income. Is it okay? So I'll give you the stages. Don't be confused. The stages is there. How you can get to your NNP at factor cost is the main important thing. So you can choose even to subtract your net tax later in the day, or somebody can decide that, oh, let me calculate the GDP at market price. Let me add my net factor income and get my gross national product at market price. Then when I finish, I subtract my depreciation, and I'm going to get my net national product at market price. Then when he finishes, he's going to subtract the taxes and add the subsidy, so that he will get the final net national product at factor cost. I hope that is okay. All right. Now we are saying that whenever we calculate our GDP, okay, we want to ensure that our economy is doing better. That is the main thing. The main thing we look at is that we want to make sure that the economy is performing and the economy is better. But whenever the GDP is increasing, we become happy that our GDP is increasing. And the question that we ask ourselves is that, how can the GDP increase? One is that we should increase productivity. Okay, so when GDP is increasing, it means that productivity is increasing. And when GDP that is the assumption that productivity is increasing. That is why the country's GDP is increasing. But we know that we only use prices, the market value. The GDP is the market value of the goods and services that are being produced. And how do we know the market value? The market value is the price of the commodity. So before we can compute the GDP, we are looking at the prices that are attached to the commodities that are being produced. Is that not it? So we are also arguing that, look, an increase in GDP does not necessarily mean that it's only output that will be increasing. The market prices can also increase, and the increase in market price can also change your GDP value. Is it okay? So one, we are arguing that there are two things that can change, that can make a GDP change. One is the physical output of the goods and services that are being produced, and the second one is the market price of the goods and services. Let's keep this in mind. And because of this, we try to distinguish between two GDPs. We have the nominal GDP and the real GDP, which we are going to talk about. So, which one is the best? Economists are advising that because our intention is to compare goods and services, we always have to adjust the price of the commodity whenever we are computing for the GDP. And so, the real GDP is the best GDP for us to consider anytime, because the real GDP has been adjusted with inflation. So let's try to understand the difference between your real GDP and your nominal GDP. So what is real GDP? Your real GDP measures what is your nominal GDP. So the nominal GDP measures the monetary value of output in a given period in the prices of that period. So what we are trying to do is that we are trying to capture or calculate the monetary value of outputs in a given period using the price of that period. So if I want to calculate for the GDP for 2020, I'm going to use the price of 2020 and the quantity of goods that has been produced in the year 2020 to calculate my nominal GDP. But the argument is that, what if the price of the commodity increases in 2021? In 2021, if the price of the commodity increases without no increase in output, my GDP is still going to be big, high, and I will be happy that my GDP is high, but in real sense, output did not change. The only thing that changed was the price of the commodity. So that is what nominal GDP talks about. So it is the value of goods and services produced in an economy at the current price. So we are looking at the current price and the current quantity of the goods and services that was produced. So let's give ourselves an example. Let's assume that the nominal GDP for 2020 2020, which it means that it measures the value of goods and services that was produced in the year 2020 at the market price or at the prevailing price. So it tells you that the nominal GDP, we are measuring it using the price of 2020 and the 2000 and the output in 2000. And I've told you that two things will affect the nominal GDP or the GDP. One is the change in the fiscal output. So when the fiscal output changes, it will also change. And two, the change in the price of the commodity. When the price of the market value changes, the product will also change. And because prices, we are prone to inflation. Any change in price without necessarily any change in fiscal output will mislead us and say that, oh, our GDP has increased. But not knowing that the increase in the GDP is as a result of what? The increase in prices of goods and services. And to avoid this, we use the real GDP. And we are saying that the real GDP, it measures changes in fiscal output. This one, it focuses on the changes in fiscal output in an economy between two time periods by valuing all the goods and services produced in the two periods at the same price. So what we are trying to do is that here we only standardize the changes in output. We consider only one output, a 2-year output, but the focus is on one single price. We focus on one price. We use one price to calculate for 2020. We use the same price to calculate for 2021. So assume the price of onion in 2021 is 10, and the price of is 10 cedis, and the price of onion in 2022 is 3 cedis. We will focus on the price of one commodity or the price of the onion for one. So if we are interested in 3 cedis, then we are going to use the 3 cedis price to calculate for the GDP for the whole the 2 years. Please, are you getting the argument I'm trying to make? Okay, Evelyn.
Yes, please.
I have calculations. We will use the calculation, and I hope everybody will get it. I have sample questions there. We'll use it. I want you to focus on this because, please, I have been called urgently by my director. Okay, all right, go. You can go.
Thank you, sir.
Yeah. So the argument we are trying to say is that your real GDP is your nominal GDP adjusted for price changes or deflated by an appropriate price index. So let's take an example of one thing and see. Now, from this example was taken from the model, which I want us to look at. I think I took this from level 200 model. So your gross domestic product at the current price is measured in nominal terms and does not reflect the real value. So we can leave this one. Let me leave this statement and let's use practical example. Now, let's assume that Ghana's GDP as at 1990 is 200 million. And in 1991, it came to 400 million. So with this one, but just if you are asked to calculate for the growth rate using the real GDP, the nominal GDP, the growth rate here is going to give you about 100%, if you can see it. Or do you want us to calculate it? So if I want to calculate it, it's going to be, yes, okay. If I want to calculate it, it's going to be the new year value. My current year, and which one is the new year? 1990 is our new year, okay. So now it's a new year. So we are going to have 400 minus the old year, which is 200, divided by 200, which is the old year value, times 100. That's how we calculate for growth rate. We calculate for growth rate by looking at the new year value minus the old year value divided by the old year value times 100. So the current year, or you can say the current year minus the previous year divided by the previous year times 100. Okay. So when I do this, I'm going to get this times this minus this is going to give me 200 minus another 200 times 100. And this will give you 100%. So by just looking at it, we can say that our GDP has increased by 100%. And our growth rate is 100%, meaning that the economy has expanded by 100%, looking at this value. And these are in nominal terms, okay? Because we did not consider inflation. We have not considered inflation here. So what we are trying to say is that if we calculate the growth rate or the expansion in the output, we are going to say that the economy has expanded by 100%. But that cannot be true. That could be false. So what we are saying that it looks the GDP has doubled in 1991. It does not reflect the real flow of goods and services, okay? Because there could be an increase in the price level due to inflation. We did not consider inflation. Now, the question went further to ask, give us a deflator. We use deflator to access the inflation. Okay, so the question went further. Say, please. We can't hear. Please, can you hear me? Hello?
Yes,
Yes,
please.
sir. I hear you loud and clear.
Okay. So, now to know the actual value, we eliminate the inflationary or the rising price effect so that we know the actual value or the actual volume or the actual increase in national income. And how do we do it? We try to convert our nominal GDP to real GDP. Okay. So the way how we can convert our nominal GDP to real GDP is to say that your real GDP is equal to your nominal GDP divided by inflation price index. Okay, the price index is what we can use to determine inflation. I'll talk to you about it. Times 100. Or you can say that your real GDP is equal to your nominal GDP over the GDP deflator. If they don't give you price index and they give you a GDP deflator, it's the same thing. So we are deflating the nominal GDP using the GDP deflator. I hope that one too is understood. So what we are trying to say is that...
Please come again.
I'm saying that we use, if you look at what we did here, we had 100%. 100% growth rate because we did not factor in inflation. So if you are using nominal GDP to calculate, you may be deceiving yourself because you may think that your economy is expanding, not knowing that it is inflation that is rather causing your country to expand. Okay, so assuming that you have a bag of rice, and the bag of rice initially was 20 cedis, and you want to calculate the GDP, you are saying that GDP is the monetary value of our production, final goods and services that went on. But we are saying that now the bag of rice was 20 cedis. Now the bag of rice is now 50 cedis. So if I want to calculate for the monetary value, it's not going to be 20 cedis. It's not going to be 50 cedis. And we all know that 50 cedis is bigger than 20 cedis. That is one thing. Meanwhile, the value of the bag of rice that we produce has not changed. It's still the one bag of rice that we produce. But we are going to tell people that, oh, look, our economy has expanded because first we were having a GDP of 500 Ghana 20 cedis. Now we are having a GDP of 50 cedis. We didn't tell the people that, look, what is causing GDP to increase is the price. So economists are saying that when you rely on the nominal GDP, you will be misleading the economy. So the best is to convert it from nominal to real GDP so that you can make a better comparison. And to convert it, you need to factor in price index or an inflation index, or we call it a deflator. Okay, you are using a deflator. So how do we convert it? To convert it, your nominal GDP to real GDP, it is your nominal GDP divided by the price index times 100. Is it understood?
Yes, please.
So in 1990, we were given our real GDP, our nominal GDP for 1990, we said was 200. Okay. And in 1991, we said it is now 400. But we are saying that this 400, we did not consider inflation. We did not consider inflation. So now we have to deflate this by considering inflation. And the question went further to give an inflationary rate or price index. I'm telling you that when they give you a price index, we are just referring to the GDP deflator. It's the same thing. So they gave us a deflator of 160. Okay. Now, what we are going to do is that we are going to have our real GDP. Instead of nominal, we are going to convert the nominal into real for 1991. For this one, the base, these are base, so this one we don't touch it because we want to compare. And if I want to compare that somebody is handsome, I need to get another person, two people, before I can compare and say, oh, this guy is handsome. Okay. So that is what we do. We use one as a reference point. So we use the base one, which is the previous year, which is 200 as a base year. So we don't touch it. It's just like how it is. And then we come to the 1991 and convert the 1991 into real GDP. So the 1991, we are going to have our nominal GDP was 400 divided by the GDP deflator, which is 160 times 100. Okay, and this will cancel that. Those with calculator, when you calculate this out, you are going to get 250. Please do say it. When you calculate this, you are going to get 250. So it tells you that our real GDP for 1991, or our GDP for 1991 should have been 250 if we consider inflation. If we had considered inflation, it would have been 290. So if I want to find the growth rate from 1990 to 1991, then I'm not going to use 400 again. I'm going to use 250 if I want to find the growth rate. So in that case, we all know how to find the growth rate. I told you that the growth rate is the current year minus the previous year times divided by the previous year times 100. So if I want to find the growth rate, the current year was 1991. I'm going to get 250 minus 200 divided by 200 times 100. And when you do this, you are going to get 50 over 200 times 100. This will cancel. Your 2 will cancel 50, 25. So you see, this one gave us 25%. So it tells us that if we try to consider inflation in our calculation, then our growth rate is going to be 25% instead of 100%. Is it understood? Okay. All right. So I gave a question here. This is a sample question that I gave to you. And I'm saying that with a nominal value in 1999, output will increase. Okay, this is just an away. I gave a question here. Okay, let's assume the Ghanaian economy produces 2 goods. So here we have been restricted. Ghanaian economy is producing only 2 goods. Okay. And the Ghanaian economy produce guitar and drums. Please take this one seriously because I think this question came last year. So when you know how you solve such a question, you'll be able to know how you can approach it when it comes to the exams. So the Ghanaian economy produces 2 commodities. This one, we have been given the price of the commodity, which is guitar. We You have also been given the quantity of guitar. You have been given the price of drums. You have also been given the quantity of the drums. And the question says that calculate the nominal GDP. So this one tells us that the guitar and the drums are final goods that we are considering. So the assumption holds that these are final goods. Calculate nominal GDP and calculate your real GDP. Okay. So the nominal GDP will simply be the price of guitar and the quantity of guitar that was produced, plus the price of drums and the quantity of drums that was produced. So if you look here, in 2015, the nominal GDP gave us $500. So we have the price of guitar is $500 times the quantity of guitar that was produced, which is 100 units, plus the price of drums, which is $1,000 times the quantity of drums that was produced, which is $250. And when you do, you sum the two, you get $75,000. That's the nominal GDP. And the question went further to say that, look, that of 2026. So when you go to 2026 or 2016, the price of guitar is 550.20. The quantity of guitar is 110, plus the price of drum times the quantity of drum. That is nominal GDP. Okay. Now, that is that. So we've been able to calculate for the nominal GDP. Then we say that calculate for the real GDP. And I told you that with the real GDP, we use a single price for the two commodities. So the only thing that changes is the quantity of the commodity, but the price of the commodity is the same. So there's always an assumption to such questions that assume 2015 is the base year. So when you see the 2015 is the base year, then it means that you are going to use 2015 price for all your calculations when you are doing the nominal, or when you are doing with the real GDP. So what do? If I want to calculate the nominal GDP, the real GDP for 2015, I'm going to use the price of 2015, not the quantities, the price of 2015. Okay. So the price of the guitar for 2015 was 500. So you could see it here, times the quantity of guitar that was being bought or sold, which is 100, plus the price of drum, which is 100, times the quantity of drum, which is 25. And when I add all, I'm going to get 775,000. So you could see that your real GDP and the nominal GDP on the base year are the same. On the base year are the same. Then I go to 2016. The clue is that use the base year price. Use the base year price. So here, instead of me using 520, I'm using the base year price. So when I use the base year price, I'll use 500 instead of 550. And I'll consider the quantity, which is 110. I'll consider the quantity, which is 110. Then when I come to grams, I'll use the base year price, which is 1,000. But the quantity is 30. I'll use the quantity, which is 30. When I add, I am going to get 855. Now compare the two. You see that the real GDP is lower than the nominal GDP. It tells you that we did not consider the price changes when we were calculating the nominal GDP. But you know that in 2016, price increase, but we focus on the 2015, which is the base year price. So I believe you can do same for 2017. So after you have gotten your real GDP and your nominal GDP, they can go further and ask you to calculate the GDP deflator or the price index. This time, they can ask you to calculate the price index or the GDP deflator. And how do we do that? How do we do that? To get this is a different question. The one that you are seeing on the screen is also a different question. So when I share with you, you can go through it. How to calculate the nominal GDP, how to calculate the real GDP. You can go through it and look at it. So the next question that we try to ask you is maybe calculate for the price index or the GDP deflator. And the price index or the GDP deflator is giving us your nominal GDP divided by your real GDP times 100. So let's look at something here. Let's look at this. Who can tell me something about this one? I told you that your price index is the same as your GDP deflator. Okay.
Yes, sir. Yes, sir.
So have you seen the relation? I told you that your real GDP, so if I've not even given you that formula, I think you can even deduce it from here. I told you that your real GDP is equal to your nominal GDP divided by the price index. And now we are asking
times 100%.
Yes, times 100%. Now we are asking you, calculate the price deflator or the price index. And you have this formula. What do? You make this one the subject of the equation. Have you seen it? So how do you make it the subject of the equation? We will only want this price index to stand on the left. So for me to do that, I can multiply through by price index. Here also by price index. And I'll divide this. This one will go away. Because I want the price index to stay alone, I'll divide through by what? Real GDP. Is that not it? I'll divide here also by real GDP. So my price index or my price deflator is going to be my nominal GDP all over my real GDP times 100. I don't know if you are getting it. You are getting it.
Yes, sir.
All right.
We are getting it.
All right. Yes. So I can say that my GDP deflator is equal to my nominal GDP over my real GDP times 100. And by the grace of God, you have been able to calculate your nominal GDP. You have been able to calculate your real GDP. So what do? Okay. So please, what do? By the grace of God, we have been able to calculate our nominal GDP. You have been able to calculate our real GDP. And they are asking you to find the GDP deflator or the price index. What will you do?
So after making the price deflator, GDP deflator, you make it the subject and then substitute your values of nominal and real GDP times 100.
Exactly. For each year. So you know your nominal GDP divided by your real GDP times 100. Okay. So when you do that, that one will give you the GDP deflator. And the person can go ahead and say that, oh, calculate the inflation rate. Calculate the inflation rate. Now, when you are coming to calculate the inflation rate, we always use the base year category. But let me tell you the clue. If you are getting a GDP deflator of 160, it simply means that inflation rate is 60%. So if your GDP deflator is 120, even if you don't want to do any calculation, this is telling you that you are getting an inflation rate of 20%. What if you are getting a GDP deflator of 85? If your GDP deflator is 85, it tells you that your inflation is going to be what? Negative 15%. Is it okay? Am I making some sense here?
So take it again.
I am saying that when your GDP growth rate, your GDP deflator is 160, it simply means that the inflation rate of that country is 60%. When the GDP growth rate, when the GDP deflator or the price index is equal to 120, what is telling you is that inflation is 20%. when your GDP deflator is equal to 85, what is telling you is that inflation is negative 15%.
Okay.
Okay. So what we are trying to tell you that whenever you want to make the analysis, we compare one value to another value. You are comparing one value to another value.
Please, sir, can you take that again?
I am saying that when your GDP deflator, when the GDP deflator or the price index, now we've been able to know that your GDP deflator is the same as the price index. Okay. When the GDP deflator is 160, it means that inflation is 60. You are only taking 100. 100 minus 160. So you only take 100 minus 120. 100 minus this. Is it accepted? Is it accepted? Okay. So if it's accepted, why do you think that we always take 100? Yeah. Why do you think we always take 100 Ghana cedis? We take 100 from the value, from the GDP deflator. Why? Can somebody tell me why we take 100 from it? But is that mean normal? It's 100? Yes, Joshua. It means that the base year category is always 100. I told you that we make comparison relative to base year. Okay, we make category comparison relative to base year. So always look at the base year. So what can you deduce from my base year category? We are saying that the base year is 2015 from this question. Now, if the base year is 2015, what was the real GDP? Is it not 75,000? What was the nominal GDP? Is it not 75,000? Okay, and we are saying that GDP deflator is what? Your nominal GDP divided by your real GDP times 100. So when I multiply this, I'm going to get 100%. So the inflation rate on the base year is always 100%. I say inflation rate.
Okay.
The GDP deflator on the base year is always 100%. Because at the base year, your nominal GDP is equal to your real GDP. Is it okay? You are welcome. So I have a question here for you. When you are getting a negative value, what does it mean? When your inflation rate is negative, what does it mean? Please.
General fall in price.
A general fall in price. Okay, so it means that the price, and it means that there is a deflation. Okay, so it tells you that there is a deflation. When you have a negative inflation, it tells you there's a deflation. And when your inflation rate is positive, it means that price of goods and services are increasing. But people get confused. I was asked about this question. I don't know if somebody can answer me. They said that last year inflation was 5%, and this year inflation is 2%. Why is price still increasing? Can somebody explain why? Last year inflation rate, somebody told me, I do the MPP style inflation. They said inflation is 40%. Let's assume it's 40%. Now, yes, Hussein, please, can you tell me why?
It means the rate of increase of last year was 5%, and now it is 2%. So
yes,
that doesn't mean that the price will not increase, but it will increase, but the rate will be 2% this year.
Exactly. So before you can see that price of goods and services are falling, then you have to get a negative value. If you don't get a negative value, it means that prices are increasing, but the persistency or the rate at which it is increasing is lower compared to the previous year. That is all what it means. That is all what it is. So forgive me that there are some of the things that are not in the model that I'm trying to bring it in. but it is just for the clarity of whatever and better, and to get a better understanding of whatever you are doing. I hope that is okay for you people.
Yes, sir.
Yes, please.
Yes. And this calculation like this, you will not get it in your book, but it's a question that came. So I tried to solve it so that we can all have a gist about it. And another question that they asked was calculate the growth rate. And I realized that I had opportunity to mark some of the questions, and I saw that this question came. The students did well. Some of them solved all the questions, but when it got to the inflation, I realized that nobody had it. So I put it on myself that, okay, let me show you how it is done. And they can also ask you to calculate for the growth rate. Okay, they can ask you to calculate for the growth rate. And when they are asking you to calculate for the growth rate, the approach is just the same. So growth rate from each year to each year. Let's say calculate the growth rate from 2015. They always give you 2015 to 2016. So if I want to calculate the growth rate from 2015 to 2016, then all that I can say is I pick the real GDP for 2015. So at 2015, you look at the real GDP at 2015. Okay. So the real GDP at 2015 and the real GDP at 2016. They want to calculate the growth rate, which we have done it, but because if I don't mention it, some people will not know. So I told you that this is the growth rate. These are the two things we want to see. But I want to compute the growth rate. And I told you that when you are calculating for the growth rate, you look at the changes. So you look at the current year. So which one would you think would be the current year? From 2015 to 2016. So the current year real GDP is 85 minus the previous year 75 divided by the previous year 75 times 100. This will give you the growth rate. Okay, so 85 minus this will give you 100. I see 110 divided by 75 times 100. So those who have calculator can do it and give us the answer. So whatever answer you give, you get is the growth rate.
That's in thousands. The figure.
Oh, I canceled the zeros. Thousands. I took the zeros out. Okay, it will not make any difference. It won't make any difference. When you put the thousands there, it will make any difference. It's the same thing. Okay, so if you get the answer, you put it there. This is how you calculate for the growth rate. You can calculate for the rate for 2017 as well. 13.3%. Okay. Okay. All right. So 13.3% is the growth rate. So when you are calculating the growth rate, use the real GDP. Unless the question specifies that calculate the growth rate for the nominal GDP. Right? If you want to find the growth rate, you use the real GDP. I hope that is well understood. All right. All right. So we come to calculation of national income or national. I don't know the time. What's the time, please?
The time is 10:23. 9:23.
9:23.
9:23. I know that we have another 1 hour that we have to. So we have exhausted about 25 minutes. All right. We couldn't finish. So what our advice is, last time we met again, right? Hello.
I think we'll meet again.
Yes, I was told that
for 1 hour.
For 1 hour, but majority of you didn't come. I am praying.
Yes, according to our time, we didn't have it.
You didn't have it.
But I'm sure this will be the link we'll be using.
Yeah, this will be the same link.
Let's second.
So let's finalize if we are to meet. Just that.
So that time.
Yeah, that's what I'm saying. That if we can discuss, so that we can meet and finish it. But just that 11 o'clock is not favorable for me today. I'll be going for a certain program. So I want us to discuss. That's what I want us, all of us.
The problem is some of the procurement students and then management students, they have lessons. So unless we look at their timetable to see the preferable time for them.
Okay.
They are about 5 to 6.
Yeah, 5 to 6 is okay. So that's what I'm saying that we should discuss.
Okay.
Let's discuss.
But sir, try and share the slides on the WhatsApp platform.
Yeah, when I finish out. But the other one I shared, I'll give you.
And by then some of us didn't join.
Oh no, I'm saying that. And here. No, what I'm trying to say is that the slides, I gave you the slides. Is that not it?
Yeah. Yes, please.
The first one, I've given you the slides. I even wrote a small.
Yes.
With this one too, I'll give you the slides.
Yes, sir. Please, we want it.
Sir,
Yeah, after
the first slide, it was not pinned, so we those who just joined cannot get access to it.
the first slide.
Yes, please.
No, it's still on the WhatsApp page. I put it on the WhatsApp page. It's still on the WhatsApp.
I'm saying that it wasn't pinned, so we those who just joined cannot get access to it.
So we will reshare it, please.
Just go through it. You don't want to go through it again.
Sir, no, if you share something and
Because
someone
they just joined.
until it is pinned,
Because
the
they just
person
joined.
can't get access to it.
We just
Okay. I get you, man.
So we will repost it, please.
Okay, let's those who have it to resend it so that they can have it. I think I said I said 2 documents. One was an essay type document, and the other was the slide. So you should look at it. Use the document that I shared as a support, and also don't stop reading your manuals.
Okay,
the models. Read the models and use my slide as a supplement. If there's anything you don't understand, when we meet, we can talk about it. And I think that's the essence of the platform. Also, we can also talk about it. So please, boys, guys, let's judge.
Okay,
Sir, so are we meeting this today 5 o'clock?
No, that's what I'm saying, that you should discuss.
we will suggest the 5 will be
I
okay.
think that time is okay. From 5 to 6 will be okay.
Okay, please, everybody, do agree to it? The 5 to 6. Okay.
Yes, sir. Yes, sir.
Okay.
Yes,
Please,
sir.
I want to see a latter class. Last time I came, it was only 50 people.
Today will be more than that.
All right, please. I wish you all the.
Please, 5 o'clock. Some of us we have class. So
you have class.
yes, please.
Which class is that, please?
Procurement.
Okay. When are you closing?
6 o'clock.
6. So, guys, can we make it? Is it possible for you to make it?
Wow.
Hello.
From 7 to 9, we have managers around us. So.
No, I'm saying that can we make it 6 to 7 because of our procurement people.
So, okay, we have classes. 6 to 7 will be okay. 6 to 7 will be good.
No, we have class at 7. No?
We have class at 7.
And I'm
saying
that
we
we can fix it.
Then we'll continue with the other one.
Hey, so 7 is okay.
So when we finish it at 6, 7, then we continue.
We continue the managers around.
Yes.
That's what I'm trying to say. I'm saying that.
Yes, sir. It will be okay.
So 7 is okay, sir.
Procurement side there.
5 to 6. Procurement is 5 to 6.
So can you join from 6 to 7?
Yes, please.
So that we will adjust 1 hour. We'll do 1 hour.
Yes, sir.
All right. 6 to 7 is good.
6 to 7 is good. So let's try and do it so that everybody will become.
Okay, thank you.
Okay, sir.
But let me see. Sana Hannah. Nima Hannah. Are you also there? I told you that in my class, I take a RuPaul. So that is what I it's a 2 marks. I give 2 marks, especially when based on the presentation. So sure, I'll give you.
Okay, sir.
So we always try to. I wish you all the best. Let's meet at the time.
Thank you, sir.
Let's come.
Thank you, sir.
Bye
Same
bye.
to you.
Bye. Thank you.
Hey, Sam, I didn't hear anything until the class is done.
Evelyn.
Hey,
Evelyn, is it from Evelyn?
yes, sir.
Hey, why? I'm shocked.
Yes, I was talking.